Hello and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Andrew Cartwright, investment manager based out of our Birmingham office. And this week, I'm delighted to be joined by regular commentator and head of fixed interest research, Richard Carter, and head of property research, Oli Creasey. Welcome, Richard and Oli. So events in the Middle East continued to dominate the news headlines last week. And Richard, in last week's podcast with Gemma Woodward, you mentioned that you expected some form of retaliation from Iran in response to the US bombing their nuclear sites. And indeed, last Monday, there was a well-publicized attack on a US military base in Qatar. And within hours, President Trump had thanked Iran for its advance warning and immediately declared a ceasefire to what has been labeled the 12-day war. Richard, there has certainly seemed to be a lot of drama last week, and Trump was once again very much at the center of what I can only describe as one of the politest acts of war and retaliation that there could have been. Whether or not peace holds in the Middle East, of course, remains to be seen. But what did you make of those events last week, and how did financial markets react?
Yeah, I agree, Andy. The news agenda seems to move on so quickly at the moment. It's hard to keep up, and Trump seems to be pretty much at the centre of all of it. I mean, it was amazing how quickly it went from the, as you say, well sort of flagged, well telegraphed attack on the base in Qatar to then a ceasefire and kind of peace effectively between Israel and Iran. So it's amazing, and markets were definitely very pleased that happened. We've seen a big drop in the oil price last week, which is obviously one of the big transmission mechanisms when you get worries in the Middle East. So yeah, there's definitely positive developments by the end of it, but like we know, peace doesn't tend to last very long in the Middle East, and there's massive doubts of whether Iran's really willing to give up its nuclear program. So you wouldn't bet against this whole thing sort of brewing up again in the near future.
And last week, we also heard Jay Powell, the chair of the US Federal Reserve Bank, announce in his semi-annual address to Congress that he would not support a further cut in interest rates in the US until at least September. And he prefers to wait and see how the impact of tariffs will filter through into the economy over the summer months. But in stark contrast, two other Federal Reserve Board members said that they would support a rate cut in July. And it's also no secret that Trump has been calling for the Fed to cut interest rates far quicker than has been the case. And he has publicly criticized Jay Powell on numerous occasions. And with Powell due to step down when his term elapses in May 2026, there's even been suggestions that Trump might nominate a new chair well before then. Richard, there has been mounting political pressure on Jay Powell for quite some time, and surely if Trump does nominate a new chair before next May, that will undermine not just Powell, but the Federal Reserve itself. We also had various economic reports released in the US last week, which included the housing market and consumer confidence. Were those reports meaningful, and what do you think we can expect from the Federal Reserve's meeting in July and for the trajectory of future US interest rates?
Yeah, I mean, there's almost certainly not going to be any rate cut in July from the Fed. Yes, like you say, they had a couple of people, a couple of members of the FOMC saying they would support a rate cut, but I do think there might have been a little bit of political positioning of some people around whether they might be a Trump-friendly successor to Powell at some point. But I don't think the majority of the committee is anywhere close to voting for a rate cut in July, but after that, September is quite possible, and markets think we'll probably see a couple of 25 basis point rate cuts by year end. I mean, the data you alluded to, certainly some things around the housing, something about around sort of jobless claims, those sorts of things. They are looking a little bit soft. Inflation pressures don't seem to be too bad, but understandably, Jay Powell and the majority of the Fed committee want to wait and see what the impact of tariffs are. We've still got a lot of uncertainty around that. And assuming the inflation impact isn't too bad, then rate cuts will probably resume sometime in the autumn.
And finally, Richard, over the weekend, the US Senate very narrowly voted in favour of progressing what President Trump has described as his big, beautiful bill, which would extend tax cuts, reduce social spending, and increase federal debt. And Richard, Trump is looking to push through this bill by the 4th of July, and that's perhaps no coincidence. And if successful, how important do you think this bill potentially is? Could it have significant implications for the US economy and financial markets? And with the end of the 90-day tariff pause fast approaching on the 9th of July, what will you be watching out for in the run-up to that deadline?
Yeah, so firstly, I mean, there's still quite a bit, horse trading to be done in Washington before the bill can pass. But with Trump sort of piling the pressure on everyone who opposes him, it's quite possible it gets done by the 4th of July. I wouldn't expect a massive reaction from markets, if I'm honest. I think really investors expect it to get done, and it would be more of a shock if there was big changes to the bill or if the deadline slipped by a long time. And so these tax cuts are coming, which will, all things being equal, benefit the economy. But the fiscal worries will remain. They're not as strong at the moment as they were maybe a couple of months or so ago. But I think the fact that the deficit in the US during good economic times is still going to remain very wide will, continue to be a worry for markets. So that's going to be the main long-term impact. In terms of the tariffs, I mean, those are supposed to be, trade deals are supposed to be wrapped up by the 9th of July, or tariffs are going up again. We'll see. It's another deadline that could possibly slip if Trump decides he wants to give it a bit more time. But that's clearly going to be the big thing over the next couple of weeks. There is some quite important data this week. Non-farm payrolls mainly is kind of the big one, which is going to be out on Thursday because of the July 4th holiday on Friday. So jobs data, as I say, has been weakening at the margin. That'll be a good one to watch. But the Fed, as I said, will have to wait probably until September before it can cut rates.
Thank you, Richard. So as we heard, there's a lot going on at the moment on the international scene, and notably in the US, and with President Trump as always. But to turn our attention to more domestic matters, I'm delighted to welcome back Oli Creasey, who this week is joining us in his capacity as head of property research. And along with gilts, other fixed interest investments, and cash savings, property is another key asset class that tends to be sensitive to interest rate movements. We've now had 4 interest rate cuts in the UK since August 2024. And in a speech last week, Andrew Bailey, the governor of the Bank of England, said that he anticipates further rate cuts in due course as short-term inflation pressures start to subside. Oli, there, as well as interest rate changes, there have also been other factors influencing some of the property subsectors that you cover, including the change in stamp duty, which became effective from 1st of April. And it is still yet unclear what the long-term implications for office space might be in the post-COVID era. Could you give us an update on how property investments have performed as the interest rate cycle has turned? Have there been any particular areas that have stood out, whether for positive or adverse reasons? And what are your thoughts for the outlook for the sector as we continue to move further into the lower interest rate environment?
Hi, Andrew. Thank you very much for having me on the podcast again. Good question. A lot of ground to cover. Let me just see how far I can get. I think let's start with residential property. I think you were really smart to highlight the change in stamp duty that occurred at the beginning of April. I think that's been throwing off a few wild data points, let's say. There was obviously a lot of activity in March with people trying to get deals completed prior to that deadline, and a bit of a drop off in April when clearly that sort of reversed back out. So what we've seen is quite a few short-term data points that, as I say, look quite they're quite extreme. Prices up, then down quite harshly. So I would just caution everyone to maybe just take a breath on that and let some of the longer term evidence prove out. It's fair to say that the stamp duty change has not been positive for the housing market. House prices are likely to rise less quickly in the wake of that, but exactly how meaningful an impact that is and what else is impacting it does remain to be seen. We are seeing interest rates fall, and we are seeing that impact positively on mortgage rates. But again, there's a lot of moving parts to the residential market, and I have to say I'm not super bullish on it at the moment. As I look forward, it seems like quite a tough sector to make money in. Certainly when capital values are being talked about, I wouldn't want to make any promises about rising property values in certainly in the near to medium term. But we will have to wait and see how that pans out, because it's an emotional market, and I have been wrong on it before. So watch this space. When it comes to commercial property, actually, I think the outlook is a little bit more positive. The market there is a little bit more rational. It reacted more rationally when interest rates went up. I think that was fair enough when we looked at what happened a few years ago now. But likewise, we expect it to be a little bit more rational when those rates come down again. So as the interest rates fall, you would expect property yields to come in a little bit, and for that to have some positive value, some positive impact on capital values as well. And what is interesting to me is that we're actually seeing that impact felt reasonably positively across most UK commercial property sectors. So whether it's retail parks, even shopping centres, even London office, and perhaps not so much offices outside of London, but certainly in the centre of the capital, we're seeing a reasonably positive recent history in terms of those capital values and also outlook. Mostly for the time being, it's being driven by rental growth rather than yield compression, but I think there's a little bit of both of those to come as well. And I think it's really interesting that you highlighted the office market, because as I look at that in particular, I do think it's one of the subsectors where potentially the sort of consensus is not where I see it, where I think it should be, let me say, perhaps. I actually think the outlook for the office market is reasonably positive. I think when we look at footfall data, usage, occupancy statistics, the trend hasn't settled. It hasn't found a sort of a steady state yet, and actually it's heading back in the direction of higher office use again. So clearly we've had 5 years where the office has been out of favour, and you and I haven't been in the office every day. That may not persist, and it may be that we're either compelled into the office by our employers, or just by our desire to sort of meet in person. And I think we need to just hold fire on that a little bit and watch how that trend develops, because I think it hasn't finished yet. So I think the office market is one that deserves a little bit closer scrutiny, and actually I think has a more positive outlook than perhaps the average forecast suggests.
And Oli, there have also been some sort of very interesting developments in recent months, with a notable pickup in merger and takeover activity. And I can't really think of there's been that much in recent years. And notably, we've seen some of the more specialist investment trusts, including Assura and Warehouse, come into play. And in both cases, there have been competing bids. Do you think those bids coming so close together is a coincidence, or is there an underlying theme starting to emerge here? Could you tell us a little bit more about these recent takeover bids? Who is making them, and why now?
Well, it could be a coincidence, I suppose, but I think the volume of transactions ongoing or recently completed needs close scrutiny, and I think there is a message there. So just to provide the listener with a little bit of background, we cover direct property investments. We also cover investments in property companies, mostly sort of captured as REIT structures. And Andrew is absolutely right to highlight that there's now been, I think there's 5 companies, 5 UK businesses that are either in the works with a takeover bid or have recently been taken over. And it represents about £4 billion worth of share capital, which is changing hands. And I agree, it is an unusually high frequency that this seems to be happening since the start of the year. There's always a little bit of a tick over of transactions taking place, but the quantity since the start of 2025 really seems to have shifted up a gear or two. And yeah, what is interesting to me actually, so you highlighted Assura and Warehouse REIT, two really interesting transactions, because in both cases, a US private equity firm sort of came out of nowhere and made a bid, and then another UK REIT has stepped in and offered more money to the shareholders of the UK company. Well, actually, they've offered more money, but they offered it often in the form of their own shares, which is not quite a limitless pool to draw upon, but a slightly easier one than finding cash to make that transaction. Neither bid is completed yet. You never know if more activity might occur before the final whistle blows on those. But it is really interesting to me that the two parties bidding in each case, and this applies across all of those 5 main transactions that I've discussed, it's either money that is coming from US, call it private equity, in a very broad sense at least, paying cash, or it's other UK REITs and UK property experts paying mostly with shares to make it. Now, the jury's a little bit out. Are either of those sources of capital smart money? But I think it's fair to say that they are considered an intelligent, sophisticated buyers, and they clearly see value in this REIT market that perhaps the marginal shareholder doesn't at present. And just to sort of remind, or perhaps tell everyone for the first time, the average UK REIT is trading at something like a 25% discount to the underlying value of its assets. And now we don't know if that underlying value is perfectly accurate. It probably isn't, but it's not going to be 25% wrong. The private equity players, the other UK REITs, can see that, and they can also see the fact that, as I sort of hinted at in my answer to your first question, capital values are rising across the board in UK property, certainly in UK commercial property, and taking on exposure to that is much less risky today than it was a few years ago. So I think, there is a trend there. There is some fairly big pools of capital making bids, and I suspect that unless prices increase, some more will emerge in time. So again, it's another one of those watch this space moments, but 2025 could well prove to be the year of REIT M&A.
Oli, Richard, thank you both very much for those great insights, and to you all for listening. Did you enjoy our discussion on the podcast today? We love to hear from our listeners, so please review the show now wherever you're listening, and share it on your socials, and tag us at Quilter Cheviot. To make sure you don't miss a future episode, tap the subscribe button. We'll be back next week, and in the meantime, head over to our website, www.quiltercheviot.com, where you can read the company market overview, as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or on our social media pages. Finally, do you have any questions that you'd like to ask one of our experts for our next podcast? Simply ask them via the weekly comments page on our website. We love to hear your questions. And that's it for today. So thanks again to Richard and Oli, and to you all for listening. See you next time.